All right, I want to talk some MMT now. I had a discussion with somebody yesterday, asked me a question, and the question was, Mike, why doesn't the Fed just set the policy rate, the Fed funds rate at zero, and let the market figure out, what the yield should be on bonds and longer term treasuries? And I said, if the Fed were to state that the rate is zero, the policy rate, the Fed funds rate is zero from now on, then the whole rest of the curve would trend down towards zero very quickly, actually. By the way, what is a 2-year yield? What is a 5-year yield? What's a 10-year? What's a 30-year? All those things are a reflection of the expectation for Fed policy over the term. So a 2-year yield basically reflects investors' expectation for Fed policy over a 2-year period. A 10-year yield would reflect investor expectations of Fed policy over a 10-year period. But if the Fed said it was keeping rates at zero forever, then the rates would all go down to zero. And way out there at the end of the curve, the reason it would go down to zero is because investors looking for yield, searching for yield. Well, I'm not going to go to a 1-year. I know the Fed's going to be at zero. I'm not going to go for a 2-year. Let me go to a 5-year. So everyone piles in a 5-year. It goes down to zero. Okay, we can't do that. Everyone piles in a 10-year. So you see, the funds, the investable funds just flow all the way out, and it drives everything down to zero. Okay, but actually the most important thing to understand here is that for a country that issues its own currency, like the United States, and where that currency floats freely, in other words, there's no fixed exchange rate, there's no convertibility like on a gold standard, the natural rate of interest is zero. And I see a lot of articles and people, complaining and whining. You get idiots like Schiff, and even people like Bill+Gross, who is completely, the guy is like totally misinformed on this stuff. And I spoke a lot about Bill+Gross. I've written a lot about Bill+Gross, but he's like, oh, the Fed is manipulating the markets and keeping the rates low. The fact of the matter is that if the Fed were to just close up shop tomorrow and leave, rates would fall to zero. And that's because the spending by government would cause reserves to pile up in the banking system. And then, banks then competing to lend excess reserves, the rates would just trend right down to zero very quickly. And as a matter of fact, Janet Yellen, in her speech on Friday, you can go look this up, she acknowledged this. She said one of the most important policy changes that was enacted to give the Fed a lot more ability in its ability to set rates was when Congress granted the Fed the authority to pay interest on reserves. She said prior to that, we had to be very active in manipulating the level of reserves. She said reserves would end up becoming too plentiful for us to control our policy rate. In other words, they would build up, that the rate would go down to zero no matter what the Fed tried to do. Okay? The other thing is that it's kind of ludicrous to think that the market sets a price for a monopolist. Okay, the United States of America is a monopolist when it comes to the U.S. dollar, and it decides what rate it will pay to people holding its currencies, if any. I mean, why does it pay any rate at all? It doesn't have to. It has the ability, as any monopoly entity does. It can issue the dollar without limit. That's just paying an interest rate is just another form of government spending. It's like, that money can be spent on schools and hospitals and infrastructure and scientific research facilities and welfare checks. It doesn't matter. I mean, it's just another form of spending. I don't think it's a very effective form of spending either. Okay? And ever since 2008, and this is basically implied in Yellen's comment, and she's absolutely right, ever since 2008, when Congress gave the Fed authority to pay interest on reserves, the sale of government securities became totally unnecessary, because the only reason they were being sold prior to 2008 was because they functioned as a reserve drain. At the Fed right there, she explained she didn't want, they couldn't allow the level of reserves to become too plentiful, her own words, otherwise they'd lose control of the policy rate. It would go down to zero. Don't have to worry about that anymore. Don't need to drain reserves. They could pile up to whatever level, because no bank is going to lend below what the Fed will pay them on their reserves. Very simple. So when the Fed says we'll pay 50 basis points or 75 or a full percent, whatever it is, that's what they're going to, nobody's going to lend below that, because that's like putting a tax on yourself. So there's no such thing as the market setting rates. Under a gold standard, that would be different. Under a fixed exchange rate regime, that would be different, okay? But under a floating FX, sovereign currency issuer, where the country spends in its own money, then, just stop saying stuff like that. Oh, I wish the market, it's like an idiot Schiff comment. I wish it would be so hilarious. You know what the problem is? These people, they don't understand. They're very ignorant. They don't understand. And then reality flies in the face of their beliefs. And rather than take the time and effort to understand it, to go, hey, why is this not happening the way I thought? They'll just rationalize something like, oh, that's the Fed manipulating. The irony is the Fed is manipulating, but it's manipulating it to pay a positive rate. Otherwise, the rates would just go to zero. Go right to zero. So that's my MMT lesson for today. See you later. Bye-bye.